Right, good evening everyone. Happy Labor Day and of course Selamat Hari Raya in advance. I'm Kelvin from Round and Search. Thank you for joining into our live stream session over here. So today we're going to talk about how we can actually make profit or trade in the stock market with just 20,000 in your trading portfolio. So before we start, do like us, and if let's say this is the first time that you look into it, so don't miss this whole session over here, because we're going to talk about a few things that all of the traders or maybe the beginners you have to know. And maybe you have been trading in the stock market, but you find that there are you have not been able to make consistent profit, but while you look into your portfolio, you still have some profit of some of the trades, but of course there are some losses as well. But how come you're still not able to make profit from the stock market? So that's why it's important for you to stay on to this live stream to find out the reason why. Or if let's say you were already making profit from the stock market, then you wish to actually maximize it more or optimize your trading portfolio or your returns, then you should actually stay and watch until the end and help yourself how to improve into this. Okay, so remember, if let's say this is the first time that you look into our live stream over here, you can like us on Facebook or you subscribe to our YouTube channel. So you will find that every week we're gonna go through the market, how to do intraday trading in Malaysian market and also in the US market also. And of course, sometimes we actually do some market outlook sharing to all the retail investors, so you will be able to get some insight what to do next for the next coming market. So you can watch some of our live stream previously that we have successfully mentioned about the market is going to have a retrace, when is it going to have a rebound, and all these things in the market. So why we can do that is because our analysis actually we look into transaction data of the big boys. So from there we would know like whether the big boys they will have the intention to throw the price down lower, or they want to push the price up higher, or their demand is actually coming in at the bottom. So we know that the market is going to have a rebound. Okay, so let's not talk so much about that. You can find out more about us in our Facebook, our website, and also our YouTube channel, those videos that we have posts. Okay, so one thing is that what I'm going to share with you here today, or any of the analysis, I'm not going to use any any traditional technical analysis, such as like plotting the resistance or the support or maybe the indicators. No, we are not going to use that. Why? Because I've been using that. I think that most of you actually use that as well. Are using that as well. So the things that I find that is not very consistent. Not consistent in the sense that there's too many guessing using all this resistance breakout or the support. So it's always like the price is down and then look for the next support, and then goes down again and then look for the next support. So it's forever looking for the next one. So that's why I throw everything what I've learned previously using all this traditional analysis. So then I look into the big boys, because most of us we know in the market who actually move the price, who actually create the demand and also the supply in the stock market to move the price up or down. Okay, not just stock market. You can look into some of the other markets such as cryptocurrency or maybe futures or maybe some of the commodities as well. Okay, so all these are the big boys game. So we have to know how to follow them, and that's why you will be able to actually move in and out a few steps before, or knowing that the market is going to turn back, or maybe the stocks is going to go down or go up a few steps before a lot of retail investors. Okay, because most of the retail investors, they are learning something like the traditional technical analysis, which is everyone learn the same textbook. You never see anyone that actually learn from the textbook and then are able to achieve more from that, because those are just basics, and also sort of like things that to tell us what is happening right now. What we really want to know is that what is going to happen next, so that we traders we can actually look into it. Unless you are an academic, or you are a person that who like to post about talk about what is happening currently in the market, then you can use the traditional analysis. There's no problem with it. Okay, so that's why this is one of the reason why a lot of traders in the market, they find that they can't able to make consistent profit, because the analysis that every one of us are using in the market right now is all about telling us what is happening right now. Okay, for example, if let's say the indicator, the most common one is moving average. Okay, dead cross. One is crossed down, then it shows us that the price is telling us it's going into a downtrend. But you don't need that indicators to tell you that, because the price is already moving downwards. Or to be more understanding about the big boys, you can actually avoid that before the price actually goes down. Okay, so those are more like telling us what is happening right now. So I find it is not so helpful in that way. Okay, so that's why the analysis that we need to use is we need to know, it provides us understanding what is going on next in the market or in the stocks that we are looking at it. Okay, and then second thing, the most important thing that is a lot of people, this is always the basic, okay, the fundamental of it. So if you do this wrong, basically most of the trades that you do might be a waste of time. Okay, and that is risk management. Okay, risk management is very important. So I'm not going to talk about like a lot of calculation there, because I know I myself as a trader, I don't like to have a lot of calculation from, oh, how much should I buy, how much of the cut loss that I have to look into it. So those are the things that too much. Okay, so I'm going to use an easy way to share it to you guys. And one of the way is that what I do here is I'm going to share with you, this is basically my training course. Okay, course note over here. So you can see I have this is just the day one. So I will go through like emotional management, because this is the most important. Understand yourself. It's more about understanding yourself. If you have been trading in the market, you will find that how your emotion actually can react, or how you can handle all this stress when you're losing money, and how excited you are whenever you're actually making profit in the stock market. So you need to know how to manage your emotion. So that's why that is the first topic that we're going to talk about it. And then in order to reduce all these emotions trade in the stock market, we will look into reduce that kind of mistake or error in your trades. Then we're going to look into the initial capital. So starting from the initial capital there, we can actually reduce that to reduce the kind of fear of losing. Okay, because most of us, we always, when we step in the stock market, it's all about making profit. Okay, how much profit I want to make for 1 year, how much profit I want to make for 1 month. But we don't see that kind of potential risk in the market. Okay, so very simple here is that you can ask yourself, let's say today you have 20,000 to spare to put in your stock market. You need to ask yourself, if the 20,000, 50% is lost, is gone, so which means that 10,000 is gone, do you feel pain about it? If you feel pain about it, then you need to actually reduce that amount. Probably you reduce to like maybe 15,000, losing 7,500 of it. Do you feel pain about it? If yes, if no, okay, then you find the right trading size to put into the stock market. Okay, the reason why I say that is because most of the time, traders or retail investor, why they always lose money in the stock market, or they always hold on to the losing trades, is because they fear of missing losses. If let's say they cut the loss, which means that there's no more hope. If let's say there's no more hope, then they can't make profit, because they're hoping to make profit. So that's why they don't cut loss. They choose not to cut loss, and then let the losses go down and down and down and down. One of the reasons is because the losses per price tick or per price margin, whatever you would like to call it, is too huge. For example, 1 cent price drop, you are losing 1,000. If you're thinking this 1,000 is too much for you to handle, then that is too much. Okay, so you will not do the cut loss. So you will not do your risk management. You do not know when to exit. So that is the biggest problem. Okay, so by managing your initial capital, you can actually able to minimize that kind of chances. Then we're going to look into the position sizing. So position sizing, this is actually how we can actually minimize the risk for each trade. Each trade. Okay. So how I do it in this way is that always remind yourself, because I come up with my own position sizing. The reason is because I have the same problem or the issue that I face like every one of you. Okay, which I find that whenever I enter into a stocks and for much expensive stock, let's say 1 ringgit stocks, and then enter into a 20-cent stocks, I find that 1 ringgit actually move up, I make the profit, but the position sizing that I'm buying is lesser because it's more expensive. But for 20-cent stocks, when I'm buying, it's buying more. So when it goes down 1 cent in 20 cents, it's not able to cover the profit that I have from one ringgit. It's not able to cover the 20 cents losses there. Okay, so that's why I came up with my own risk management, the position sizing of it. So this position sizing, the principle of it is according to what Warren Buffett said. Rule number 1, never lose money. Rule number 2, never forget rule number 1. So you don't want to lose money in the market. So that's how we make the break even from that. Okay, so let me show you the difference here. Oops. This is the cut loss rules. Wait, sorry. Give me one moment. Yeah, this is it. Okay, so normal trader or investor, how much or how many units of stocks that they want to buy is usually based on this formula. Okay, let's say they have the amount of capital, then number of stocks that they want to buy, they are going to buy in one time. Then that is actually equals to the value per trade. Let's say, for example, right now you have 20,000, and then you are thinking like each time when you enter into a stock, you buy 4 stocks. So which means that each stocks you are buying at the value of 5,000 ringgit. So after the 5,000 ringgit, so this is what you can see here. Stock ABC price is at 1 ringgit. DEF is at 80 cents. GHI is 40 cents. JKL is 20 cents. So with the same value of 5,000 ringgit. So with the same value of 5,000 ringgit, 1 ringgit stocks, you are buying at 50 lots, which you can call it like 5,000 unit. 80 cent stocks, because it's cheaper, you can buy more, 6,250 units. 40 cent stock is much more cheaper, you can buy more, 125 ringgit, 12,000, okay, 12,500. 20 cent stocks, much more cheaper, so you can actually buy it at the amount of 2,500 unit. So what's the problem here? The problem is here. When you look into a price change, if half of it, let's say 1 ringgit stock is moving up 1 cent, then DEF actually goes down 1 cent. 40 cents go up 1 cent. So which means that 2 move up and 2 goes down. So if 1 ringgit goes up, you are making 50 ringgit. How I get this 50 ringgit? How the market actually calculate the profit that we make for each cent up is based on how many shares that we are buying, how many lots that we are buying. So from here we can see it's 50 lots for 1 ringgit stocks. So which means going up 1 cent, then we're going to make 50 ringgit. So if 80 cent stocks goes down 1 cent, we are losing 62 ringgit and 50 cents. And then 1 cent for this 40 cents over here goes up 1 cent, we're making 125. Then 20 cents over here, you are going down 1 cent, you're losing 250. So plus, minus, total up everything together, you'll find that at the end of the day, you are still losing 137 ringgit and 50 cents. Okay, so you can see from here, you're not protecting yourself. Yes, if let's say 20 cents stop moving up higher, then you are able to make more profit. Okay, so you're probably going to make 137 cents and 137 ringgit and 50 cents. But that is only the positive side. You're looking at the bright side. So in the stock market, we have to understand one thing: everything is risk. Everything that incur in our life is risk. We need to know how to manage it. So how we manage it is like we need to make sure if the worst case scenario, we are going to have a break even. Okay, so in this case wise, you're not protecting yourself, you're not protecting your portfolio. So 20,000 to most of us is a hard-earned money to save up until 20,000. So here is just 1 cent going down. Going down, you're losing 137 ringgit. If let's say it goes down 5 cents, let's say times 5 over here, then you are losing 500. Then goes down 10 cents, then you're losing 1,000 plus. Okay, so it's going to be a hard-earned money from it. Okay, and plus, if let's say your portfolio value, your capital goes down, then you take longer time to actually climb back up higher. Why? Because 1 ringgit goes down to 50 cents, you're losing 50%. But from 50% to go up to earn back to 1 ringgit, you need to make 100%. Okay, so my way of doing this, the risk management for the position sizing, is that the formula here is very simple. You don't have to do the calculation every time you enter into a trade. You just need to find the initial capital the first time, or when you start to use this method. Right now, how much of capital that you have in your trust account, use that, multiply by 0.4, and then you will get your unit per stocks, unit per trade for you to enter into it. So in this case, if let's say 20,000, you are going to enter each of the stocks regardless of what price you are buying in at 8,000 unit. So why am I using this 0.4 over here? The reason is because each time 1 cent is down, is actually equal to 0.4% of your initial capital only. So you find that, okay, you're losing 80 ringgit, so you're fine with it. Because right now, if let's say one day, then you need to go out with your family and all those for a meal, or maybe to eat something, 80 ringgit, basically, sometimes it's very hard to cover that, okay, to pay for that bill. So 80 ringgit, you'll find that, okay, you're okay with it with just 1 cent. Okay, so that has some buffer. Of course, sometimes we exit or we cut loss maybe 3 cents. 3 cents is about like maybe 240. So at least you are still able to look for the next trade. When you move up 3 cents, you are able to cover it. Okay, so you can see from here the total value of it for 1 ringgit, you're entering 8,000 lots. Your total value for 8,000, 80 cents, 6,400, and then 40 cents, 3,200, 20 cents is 1,600. So each of it is different value, okay? But the profit and loss for per price change, okay, is the same. So because the profit and loss per price change, it doesn't, is not based on the total value that you are buying. It's based on the total number of units that you are buying. Okay, so you need to understand this, because this is very important, because a lot of people, they don't see this. Okay, and I think there's not many people actually sharing this also, because most of them, maybe some of them, they themselves, they are not really trading. Okay, so myself, I've actually looked in the market, and then last time I do a lot of trades over here, and then I also consult some of the clients of it. So I find that this is a better way for you to look into it. Even though with 2 stocks moving up, 2 stocks going down, you can still see you're just protecting your profit at 0 ringgit. Of course, this one not included the brokerage fee. If let's say include the brokerage fee, in this case, why probably about 25 ringgit per trade. So 4 trades over here, 100 ringgit. Okay, so it's still acceptable for that kind of fees that for you to pay out. Okay, but most importantly, we need to actually protect ourselves. We know when to protect ourselves. Okay, so this is one of the way that you can actually minimize that, and then you won't feel confused why you still lose money in the stock market even though you still have some trade that you are making profit. Okay, at the end of the day, you'll find that, okay, because of the total value, this one is based on my own experience, that I find that if based on value to separate like how many on the stocks that I'm buying, I find that it's not able to cover. So that's why I came up this for myself. Okay, so you don't have to do calculation every time, just use your initial capital. Then if let's say your capital actually move up to like maybe 35,000, then you can actually recalculate again using the new number of shares per unit, okay, for each different stocks. Okay, so this is one of the reason to actually, one of the way to help you solve this problem over here. Okay, so of course we do have the cut loss rules, and also we need to know how the big boys actually works, and then look into the moving house. So what is moving house over here? Why I call it moving house is because we look into big boys. Big boys do accumulation. Okay, usually big boys, when they do accumulation, you will not notice that, and you will not dare to look into it, because those are the stock that is not very liquid. Okay, so when there's not very liquid, they do it quietly, you will not notice it. So when will you notice it? It's when they want you to know. Why they want you to know? Because they want to take profit. Okay, so they'll start to push the price up higher, create volume into the top active list. Then you saw it, then you jump into it by putting a buy order at a lower price, because you find that this stocks is not at the price that you think that is worth to buy. So that's why you always park at a lower price. That is what the big boys wants you to do, because when you park lower, then that's where they throw it down lower. And that's why a lot of traders and investors, they always get trapped at the high side, because they don't know that that is actually the big boys are trying to attract your attention to get you enter at that point. Either they create a fear of missing out, or either they make you feel that, oh, hit that, and then you start to think like, wow, I buy at the right price. Okay, of course both sides is, if you put it in another way, like our position here is both are happy, because big boys are able to take profit, and then you are able to buy the shares. Okay, so that's what we call the moving house. I can show it to you later on, but after knowing all this position sizing and all this, so 20,000 that you have, can you trade in the market? What kind of method you should use? The method I'm saying is whether you want to go for long term or mid term or short term trade. Short term trade probably like 2-3 days and then you get out, or maybe you want to go for intraday trade. Of course, a lot of people would like to go for intraday trade. They always think like, oh, every day I can make a few $100 or a few hundred ringgit, and then 1 month down the road, the 20 days you can make about like 4,000 ringgit. Okay, that is the fantasy. Okay, everyone who is thinking about it, but we need to know that one thing, we have cut loss, there are risks. Okay, second thing, sometimes the market don't allow you to do so. Okay, third thing, like I say, when you enter into more expensive stock with 20,000 20,000 ringgit in hand, if you are entering into 6 ringgit stock, if you're using the position sizing, 80 lots, enter into it, 48,000. So it's out of your 20,000 capital. Okay, of course, don't ever think of going into a margin. Okay, that is I find it is a black hole. You should serve the margin account, or maybe those give you extra limit account as a credit card. Okay, you use it when you need it and you know that you can pay back, then only you use it. Okay, so that's why I never ask my client to actually open a limit account, or maybe a contra trade or margin account. Okay, so most of the stock that you can see from some of my trades, intraday trades that I did live before, most of the stock that actually move up you easily and higher margin for you to cover that cost is usually those stocks that are 2 ringgit and above. Okay, so 20,000 you can enter 2 ringgit and above, but if let's say in out, because you are buying smaller size, because you can't actually buy more. So when you buy smaller lot size, let's say 80 lots, move up one tick, you make 80 ringgit. But the brokerage fees, you need to take note of that, because the brokerage fees, 16,000, let's say 16,000, you are buying 80 ringgit, 16,000. So 16,000, which means that if let's say you use like average, the brokerage fees is about 0.1%, you are paying 16 ringgit for one stock. Okay, and then stamp duty about 16 ringgit, so 32 ringgit. All right, 32 ringgit in out, you are paying about like 64 ringgit plus. Okay, so if let's say you move up one tick, you're still able to make some profit, but not much compared to those that have a bigger fund size. Okay, so whether you want to do this every time, because day trading wise, we're not saying like you move in and out every 1 minute, every 1 minute. It's not US market. US market, you can do that. I already did it in my live stream. Okay, for intraday trade in US market, you can have a look into it. So it's totally different. So Malaysian market sometimes not that liquid, not sometimes, most of the time it's not that liquid. Stocks are moving up with just one up, one up, one up. Okay, it's not moving up and down like the US market. So you might need to sit the whole day from 9 to 5 to look into the stocks and wait for the charts. If you're lucky, you're able to take like maybe 1 cent or 2 cents of profit every day. Okay, if you know how. All right. Then let's say 15 days, sorry, maybe 10 days that you make 200 ringgit, so about 2,000 ringgit. Then another 10 days plus minus profit loss, cover up, so break even, so no. So at the end of the month, you make 2,000 ringgit. So does it worth? Starting from 9 to 5, you only make that much. Why not you go and drive Grab? You could actually make more from it. Okay, so that's why I would not recommend you guys to look into it. And plus, most of us, we have our main job or our primary income source, so we don't have that time to actually look into it. And if, let's say, because you want to quit your job and then go into it with just 20,000, I find that it's a bit too difficult for you to look at a big sacrifice for that. If let's say you can do something like, from the stock market, it's always a place for us to generate secondary income. So why not you just maintain your primary income, and while using a very little time, then you can look into a stock market and then find, okay, the secondary income from there. Let's say you are earning like maybe 5,000 ringgit per month, 5,000 plus, and then on the other side, you can actually make 2,000. The whole month is about 7,000 plus. Okay, so this is just an example. Okay, sometimes like market bad, you won't make anything from it. Okay, so back to this, what kind of trading method you should use? So seems like intraday is not going to work. So short term, mid term, and long term. Long term wise, basically we want to make secondary income, so that's why we are in trading. Okay, or if let's say you're talking about you want to make capital gain, or you want to look for into dividend, I myself, I am actually quite against dividend. People would say like they are actually focusing on dividend investing. Why I say that is because when you invest in dividend, if let's say there's no capital gain, then the price actually goes down like 50%. How many years of dividends that you need to collect in order to cover back the capital? Okay, so that's why when you're investing for dividend, you're not really for the dividend. You're actually investing it for a capital gain, because you need to have the stock price to move up higher. So the dividend that you're taking is a profit, okay, or maybe move sideways, but not many stocks are actually moving sideways that way. Okay, so that's why long term is not an option. So we left short term and mid term. So how are we going to find this? Very simple. Let me show you some examples over here. Usually we look into moving house if let's say you want to go for mid-term trades. So moving house is usually when the big boys, they want to start to push the price up higher. So this is some of the criteria that I will share into the market. Okay, so this is one example here. You can see the price usually at this point over here, the yellow box here is where they start to do the accumulation. But you will not look into it because you'll find that this is too dangerous. It's not liquid. Why? Because you see the price sometimes go up and down and things like that. Look at this. Before this, sometimes dash like this. Why the price can still move up higher? Okay, so okay, so let me share with you some of the examples here. This was a long time ago, so you can see here seal. This one, you can see the price actually move up. So sometimes they go up fast, sometimes they go down, they go up slowly. So from here, accumulation 30 over cents, they can actually move up to 40 over cents. So that's about like maybe 50% of profit. This is one of it. But moving house, they have a lot of way to do it. Okay, like this list over here, those are the stocks that they have done moving house before. Okay, like for example, they have done a few rounds from here. Every year they will, after they did, then they will just pause and then wait for the next round. Okay, same thing happened here, that you will not really look into these stocks because it's not very liquid here. Okay, but then when they are ready, after they've done the accumulation, the price will actually move up. So from here, of course, we will not enter when they are doing accumulation. When we enter, when they have the, because they're moving house, right? So they need to have the housewarming. So I call it, when the housewarming is here, then we can start to look into it. So this is about like 44.5 cents. Move up to, basically you can't exit at 1 ringgit and 15 cents, because this one they throw down very fast. I was there to see this. So probably you can actually get out at about like 105. So 40 over cents, 105, 1, 2, 3 days. Okay, so this is about like 100% plus. Okay, so this is one of it. Then also some of it is they've done moving house also. So accumulation and start to push the price up higher. Okay, so what you can do is that you don't need to have a lot of time. So you can see when they're doing accumulation, you just need to know how to identify this. Okay, so I'll share this more in our training course, because this one takes some time to actually, for me to guide you how to find the right one, what are the price movement is like, what is the volume is like, what is the intention. There's no point for me to share with you the criteria. I can share the criteria with you, but just that you don't understand the reason behind. Like for example, I just tell you what is the entry rules, then you just enter. Okay, but you don't know the reason behind, you don't know which one is the right one. Then you just use the entry rules. Like what we always do is the price and volume is higher than yesterday high, then that is our entry rules. Then whenever you see the price and volume is higher than yesterday high, let's say for example in this case over here, then you start to enter. Then next day the price down, then you cut loss. Okay, then again, then you cut loss again, then again, then you cut loss again. Then you start to say like, Kelvin way is not working. It's not working, just that you don't understand the whole thing behind. Okay, for what I share, when I want to share with you guys that the method, the trading method, is sharing the reason, let you understand the whole thing behind of all this price movement. It's not like what you have learned like easy way in the technical analysis that you usually learn, where resistance breakout, then you enter, and then after you enter, you wait for the take profit target. If let's say it doesn't hit the take profit target, then you wait again. The price goes down, and then you start to think like whether to cut loss or not. Hit your cut loss point, then you cut loss. So that is not following the market. Okay, that is just you expecting and put in the money and then wait and hope whether the price will actually hit the take profit. Okay, so that's not what I want to share to you guys. I want you guys to be able to trade by yourself. Okay, so you can either go for midterm trade, so you can see all this price move up is only a few months. April, May, June, July, done. Okay, so you need to know when is the price when they start to fall. So we have the exit rules over here. You need to understand why the price move up in this way. Why is there a retrace over here? Because the big boys, they mark up the price and they distribute. Mark up the price and they distribute. They can't throw millions of shares at the same point because you can't find buyer to buy it, right? So that is the reason why they need to sell on the way up. But when they have not much of shares in hand, then it will show some of the price and volume movement that it tells us they have not much shares in hand right now. So we better get out, because the big boys have already sold majority of their shares, and that's where the price will start to go down again. So if you don't exit at the high point over here, then your profit that you have hold, it will goes down all the way. Okay, so this one was about 30 over cents up to about 40. Exit point over here that we look into it is about 48. Okay, in 3 months time, so about like 50%. Okay, so this is one of it. So the more recent one is this one here. You can see accumulation, not very liquid, you wouldn't look into it, but when you look into it, is where the high volume is where the price start to throw it down lower. Okay, so this is where you can actually do a midterm swing. So this one is faster, just 2 months, and then hit the top, and then you can just get out. So it's an easy way. You just need to spend like maybe 30 minutes to look into it every day. Okay, not 30 minutes, a few minutes to see whether the big boys, still holding a lot of shares in hand, or they have sold majority of their shares and planning for price throwdown. Okay, so this is one of it. You can see a lot more that we have that shows this kind. So you need to, if let's say you are going for midterm, this is the method that you need to look into it. Accumulation, price push up, and then when usually the high volume here is where you start to look into it. So that's why you jump in and then trap at the high side, the price actually start to close down. So if you know how the big boys actually works, then you can actually exit at the high point. Okay, so you can exit here. So this one is about like 36 cents up to about like 1 ringgit plus. Okay, so more than 100%. So it's not all that is going into 100%. So some 50%, some 100%, some 100 plus, some 200. So you don't expect any the take profit point. Okay, so the take profit point is always following the market. So we need to know how the big boys actually work. So if you know how the big boys work, then you can also do a short-term trades. Okay, let me share with you some of the short-term trade that we have done. Like example here, this is the stock that we have looked into it. We enter on 18 April and then took profit on 66 cents over here. Next day, the price have a gap down. Okay, so how we are able to time this is because we know how the big boys actually works. We have the exit rules that either one of the exit rules actually comes in, then we have to take profit and run. So why I call it an exit rules but not a take profit rule is because when this thing price action actually comes in, we have to run. If you don't run, the price will actually goes down, because all these rules over here, it tells us this is the big boys planning to throw the price down lower. So if you don't get out right now, you would not be able to get out at a profit or maybe at a break even. So if you miss this chance, you can see 64 cents and then go down like 58 cents. So you're losing about like 6 cents over there. So that's a lot. In another way, we are making 2 cents here. Okay, so this is one of it. I can show you, these are some of the trades over here. You can see where is that stock. It's not shown here. Oh, it's down here. Okay, so it's here. So you can see 18, 20th. So 18 and then 20th, 66 cents, 64 cents. And this is the buy, this is the sell. So this one is one of the round and search portfolio. Okay, so other than this, we also have this. This is the most, I'm showing you the recent trades. So this one here is the entry is here on 7 April and then take profit here. So it's about 5.5 cents of profit. So just a few days, not until a month yet. And then here we re-enter again. So here is where our exit rules actually comes in. So we can actually cut loss, take profit and go. Okay, so this one here is, where is it? What stock is this again? Start from, okay. So all these are already done. So you shouldn't be following. And also these are just to share with you, okay, that our trade here. So this one 44.5, 7 of April. So which is here also 7 of April, and then 50 cents exit. Okay, so this is where we exit, took the profit here, then we entry here again. Okay, so this one was like 2 weeks ago trades. So basically, if you know how, you are able to move in and out from the stocks before the price actually goes down. Okay, so that's why it's important for us to know that how to follow the big boys, what are the price transaction. So there's nothing that is secret. So all this data is available to every one of us. Okay, so you can see from here, sometimes I do some of the day trade as well. You can see 8:59, 51 seconds already send in the order, and then exit at 9 o'clock is 6 minutes. So from here, 100 profit here with just a few minutes. So if you have that kind of fund, so from that one is intraday trade, so you need to actually grow it your fund first. When it reach to a certain point, you can actually do that. Okay, so this one is not ATAC, is a loss, I think, or one tick of profit, I can't remember. Okay, so then here 1 day, enter 1 day, and then make a profit of about 200 ringgit. And then here enter just same day, so this is day trade, so we don't have to look into it. So this one have a cut loss. Of course, we will have a cut loss, so it's normal to have a cut loss. If anyone show you a portfolio that they can hit 100%, basically, I don't think anyone can actually do it from there. If let's say long term wise they can do it, no. Okay, so if you can make about like 60 or 70% of probability, then it would be great. So same here, this one day trade also, this one day trade. You can see I do a lot of day trade over here. The reason is because during that time, day trade is much more fit to the market condition. So that time, that's why I can actually, short-term trade then, or maybe day trade if let's say the market allow. Okay, so that is one of it on how we can trade in the market. So short-term trade, of course, or mid-term trade, which one is actually better? There's no right or wrong, but you need to look into your time. Whether your time, your primary job, you can actually have time to watch it for short-term trade. So it's not going to take a very long time. You don't have to stick from 9 to 5 and then look into the market. So you can spare like maybe 30 minutes out and then to find the new stocks and then the old stock, whether you need to exit or take profit. So it's just that simple. If your time allow, you can go for short-term trade. If let's say your time don't allow, then you can go for mid-term trade. Okay, so the profitability is about the same. Okay, just that which one actually fits into your trading style. So up until now, you can see that I've shared starting from the risk management. So risk management wise, whether it's position sizing, whether you are doing right. Second thing is that with your trading fund, 20,000, what are the trading method that you can use? Short term or maybe mid term. So it's an option that it's up to you. And then the third one is that which one actually fits you more. So we can see that what kind of trading method fits your portfolio value, okay, your trading capital, and then what kind of trading method actually fits into your working style. Okay, so if you can't watch it every day, just go for mid-term swing. All right, if you can watch it every day, like maybe spare 30 minutes to look into it, then you can go for short-term trade. Okay, so if let's say you want to learn about this, it's very simple. We have our trading course. So for this short-term and also for finding what is the accumulation is on our first month and the second month of our training course, because our total training course is 6-month training course. Okay, so that is the full package on from accumulation, short-term trading, mid-term, and intraday trading. So we share with you all in the 6 month. So how to read the transaction data, all those. Okay, but if let's say you're not that kind of person, you just want to know how to find out the big boys moving house and how to actually look into this kind of short-term trading opportunity, then you can just join us for the first 2 months. Okay, so you just have to do the subscription for the first 2 months. 1 month is about 715 ringgit. The total whole package is 4,188. So whole package you will have the charting software like the one that I share with you with our screener built in, easier for you to find. But if let's say you go by per month, then there won't be any screener from it. Okay, so we're just going to share with you how to find this kind of stock, how you can actually look for this kind of stock in the first month and the second month. Okay, so 1 month is 715. If let's say you just want to go for 1 month to look into accumulation, then subscribe for the first month. Our intake is starting on next week, Saturday. Okay, Saturday and Sunday will be the main class that I share with you the whole thing, that how the big boys operates, and also how the price actually move up higher, and how to look for the accumulation, and also exit rules, okay, and also the short-term trading as well, okay. Then every week we will have a tutorial class that is a live one. Then we're going to use the market, okay, market example and share it to you, okay. So from there you can do the homework with the current market stocks, so you can learn from the current market, okay. So that is how we do the sharing. Use the live market materials to actually help you to learn better, okay. So we do it every week for the tutorial, okay. And of course, if let's say you miss some of the live class, the webinar class, you can watch the recording in our website. All right, so that's my sharing over here. So thank you very much for joining. If you have any question, leave it in the comment section, and I will answer you. All right, so if you want to find out more about our the course that I share with you, there is a link in the description, so you can take a look into it. Or maybe if you have any question, you can always PM us and then ask us, and then we will be happy to share it with you, okay. So don't miss this intake, which is next week. So get yourself up and then fine-tune your trading method with our operator analysis, move in and out from the stock market with a better way of to achieve a better way of return in the stock market, okay. So see you guys next time.